Hi there. We're going to talk a little bit about the planning environment and the broader economy and how that influences your financial goals, your financial plans, and maybe even your career choices. So, financial planning takes place in a dynamic environment that we often don't have control over. We do vote, right? We vote for our representatives at the state and federal level. We also can vote locally, and essentially, the government is going to be regulating um, different things about the economy that can influence our financial goals and the plans that we choose to make. So, for example, the government is responsible for codifying the rules that allow for us to have 401k plans, so tax deferred investment vehicles, or 403b plans, or our educational plans that are tax sheltered accounts for planning for your child to go to school. All of that is regulation, comes from regulations that the government has put in place. But then also, like, we're kind of part of um, how the government is choosing to act through regulations, expenditures, and tax policies that can impact how our investments are performing, if we're able to meet our financial goals. If the government, for example, was to change the property tax rate in the state of California, if it was to increase it, like that can make owning a home much more expensive than it already is. And that might reduce your ability to have a home. It could cause home prices to fall. So there's all kinds of different things that are sort of like going on, ebbing and flowing, and we're in a very dynamic environment. Government, business, and consumers are interacting. The government employs people, but the government also makes regulations. It taxes consumers, it taxes businesses. Businesses can sell goods and services to the government. And so they're all interacting. Consumers are also laborers for businesses, but then they're also consumers of business goods and services and of government services. So each of these players interacts to create the overall environment, economic environment that our financial plans and goals are subject to. So, taking a look at the business cycle, um, my background is in economics. I really enjoy talking about economics, but I will keep it brief. Right now, we actually have experienced some growth, reduction in growth of our gross domestic product. I wouldn't say that we are in a recession, and neither would anyone who's measuring recessions, which means we have 2 consecutive periods of declining GDP growth rates. And GDP is our gross domestic product, that is the value, the monetary value of all of the goods and services that are produced in our economy. But basically, this is a business cycle, and a business cycle starts out with we're in a recession and things are picking up and expanding, and we hit a peak and contract into a trough, and then we expand again. And so the length of a business cycle tends to be about 5 years. In the last 21 years or so, there have been about 3 recessions. So sometimes 5 to 7 years would be the length of a business cycle. Our financial plans and goals are definitely impacted by these business cycles that are a combination of the different actions of the government, businesses, and consumers. Uh, Recession is produced by the government, businesses, and consumers spending less than they otherwise do on goods and services and producing fewer of them. An expansion is produced by businesses, government, and consumers spending more and buying and producing more goods and services. That increases the GDP and increases the GDP growth rate. So anytime the GDP growth rate is increasing, we're in a recession. Anytime the GDP growth rate is contracting, we're in a contractionary phase of the business cycle, and also known 2 consecutive quarters recession. We did have 1 quarter of declining GDP growth, but it reversed and we have positive GDP growth again, so we didn't quite hit a recession. There are some concerns more broadly in the economy that we could enter into a recessionary phase of the business cycle. Certainly, indicators such as like the stock market show that we may be heading in that direction. The stock market declines. So when I say the stock market, I mean like a basket of equities. We have different equity indices that we follow, like the Dow Jones Industrial Average or the S&P 500. And when the value of those stocks decline, that can oftentimes indicate that we may be headed towards a recession. Labor figures can indicate that we're headed towards a recession. If we see a lot of layoffs, if companies are having a hard time paying their employees, this might lead to a recession. And generally, the labor market declines tend to lag what is occurring in the economy overall. So if people stop buying goods and services, then businesses will lay people off or stop hiring. And those, so it tends to be a lagging indicator. The stock market tends to be a leading indicator. And we're sort of caught in this time period right now where the stock market has declined. It hasn't been doing so well since, I would say, the end of 2021, and we're in 2023 now. And the labor market is kind of doing okay. There have been some recent layoffs in the technology sector, for example, but we're not seeing quite the unemployment figures that one would expect during a recession. So if we want to kind of like take a look at some of this information, so things that are impacting us more broadly in the economy could be things like inflation. And inflation is something that, like, honestly, I went to college in early 2000s, 2000 to 2004. And it was like, well, like, we could have inflation and inflation would be bad, but there's not really much that can be done when there's inflation. So when there's inflation, we oftentimes see policymakers wanting to reduce fiscal spending, meaning the government saying, like, I'm going to spend more on bridges and roads and healthcare and maybe like welfare, food and housing and healthcare for people with lower incomes. I'm going to spend less on that, which no one really ever wants to do, but like they could do that if there's inflation. And then monetary policy would pull back too, in the sense they increase interest rates, like increase your home. It ends up increasing your home loans and your auto loans. And then that reduces spending. And it's like taking a simmering pot or taking a boiling pot off the stove. It like sort of releases some of the pressure, and then hopefully prices decline. But that always impacts the economy negatively when that's done. So inflation is this challenging place that an economy can be in where we have growth, and that growth produces price increases that cause the economy to not function so well, because we don't really have a good sense of where prices are, and wages tend to then lag price increases and people can't afford things. And really the cure is to come in with less fiscal spending and tighter monetary policy, which then can negatively impact the economy. So we're negatively being impacted by inflation, and then we're negatively being impacted by reduction in government spending and tighter monetary policy. This is sort of a bad place to be. But basically, if you take a look at this is a time series percentage change in the consumer price index since the 1950s. And what we see here is kind of like what I've said, that we really didn't have too much inflation. So like CPI percentage changes on an annual basis sort of mean that a basket of everything you buy, and it doesn't always stay exactly like that, but it should increase, somewhere in the 1% to 3% range in like a healthy economy on an annual basis. And we kind of saw that. So, I mean, really since the 90s, we haven't had high inflation at all. Really, we've had very moderate inflation. 2 to 3%. Sometimes when the economy is really heating up, as we saw prior to the stock market crash of 2001, as we saw going into our last recession, there was quite a bit of inflation, or I wouldn't say quite a bit, but there was some inflation. And I don't know what portion of the economy was really driving this inflation. It may have been residential real estate and things surrounding residential real estate, right? But then, prices during that recession declined, and we actually had negative growth of the price of that basket of goods and services during the recession, which kind of makes sense. So these gray bars represent recessionary time periods. And then here we are kind of like, okay, here is like COVID is starting, and, we didn't see much inflation during COVID because consumers were not buying a lot of things. And when there isn't a lot of demand for things, then there's no reason for anyone to raise prices. But after COVID sort of ended, we see this like really high inflation, which if you kind of go back in time, like we haven't had in this country since the 80s, which was 40 years ago. And, this is actually when I was born, in an inflationary time period. And, we had a lot of inflation during the 70s. We can see here, and it coincided with a recession, right? And then we also had some inflation in the 80s, and then, slowly over time in 1980 into 1982. So it took 2 years for that inflation to sort of taper off, and it took about, let's see, we're going from 2 years for that inflation to taper off. And inflation can be problematic for a couple of reasons. So for me, inflation degrades my income, right? So I get paid the same amount, but then I have to go buy stuff. And then that makes it harder for me to save, and it makes it harder for me to meet my financial goals. And at the same time, during this inflationary time period, we didn't actually see the stock market doing that well. So at the same time that it's harder for me to meet my budget, and maybe I have to dip into my savings a little bit, so I'm not going to be able to meet my financial goals, which would be maybe retiring at a certain age with a certain amount of income. Also, stock prices are not doing so well. The overall, I would say the broad market stock indices are all pretty much down for the last year and a half. So how does the broader economy impact your financial planning and the goals that you're going to achieve? It can either benefit it with low to moderate inflation, or it can cause problems with higher inflation, which we have seen not very recently until now. And kind of looking more at that inflation, there's an attribution that was done, and I guess it's pretty easy for people at the Bureau of Labor Statistics to do this attribution. But basically what they're doing is they're saying, okay, on an annual basis, so this is the 12-month percent change in the consumer price index for all consumers. It's just kind of laying out what is the CPI. But basically looking at where that inflation came from, and you can kind of see, well, we didn't actually, that used car and truck thing that was going on where their prices were really, really high in COVID because there weren't any new cars and trucks being produced, so used cars became really expensive. Their prices went back down. But heating oil went up dramatically. A lot of, things that we really need, food prices, airline fares, insurance costs. I noticed that. My insurance agent didn't want to talk about it. But you can kind of see that our annual 12-month percentage change in the average basket of goods and services that a consumer would buy went up a little under 10% on an annual basis. And that's not normal in the US. It's normal in a developing country where they can't meet the demand, the really growing demand. You have a burgeoning middle class, for example, that's just buying houses and buying cars, and they hadn't been buying those things, and businesses can't keep up with that demand, and so you see a lot of inflation, and that's indicative actually of healthy growth. It doesn't help the growth, but it's indicative of healthy growth in an emerging economy, but not in a developed economy. In a developed economy, we would be closer to here, 2%. So this is kind of where we're seeing it all coming from in the last 12 months ended December of 2022. And the other thing I kind of wanted to look at, since there's this talk of a recession, how would the recession impact me? So there's all these things kind of swirling around, and if we have a recession, if we have 2 consecutive quarters of declining GDP, how does that affect me? It can affect my assets that I have invested. It can affect my job. I could lose my job. I definitely am not going to get a wage or salary increase during this time. it can impact, but it could actually, when GDP goes down, that can actually cause that inflation to moderate a little bit. So there are some positive aspects for us right now since we've had a lot of inflation. But this is GDP on an annual basis over the last 75 years. We just look at it in the last 10 years. But GDP generally increases. When we see the economy continuing to grow on an annual basis, that's a good sign, generally speaking. And right now, our annual GDP is about $24 trillion on an annual basis. So that's 24,349 billion. That's a pretty big number. And it's kind of cool. These tools allow you to edit things. So we could look at the percentage change in our GDP on a quarterly basis. And that's kind of how we actually measure. It's how we measure whether we're entering a recession or not, right? So when we went into the pandemic, wow, GDP really fell off in Q2, so quarter two, which would be June ending, June 30th, 2020, through the 3 months, March 30th is the end of quarter one, so April, May, and June. But GDP growth kind of ticking along. Whenever you see it go down like this, that coincides with this gray area, which tends to be a recession. So if we have a percentage change on a quarterly basis in GDP of the GDP growth rate declines for 2 quarters, that's where we have our recessions. And these are all of our recessions in here. And so how do you pivot and how do you adjust your financial plans for these recessions? I think one of the really important things to do, if you have a financial plan in place, especially if you're invested in broad market indices, bonds, real estate, it's really not a good time to sell assets or try to be too tactical unless you have some serious inside information, because it's really hard to time the market. It's fun to play around a little bit if you have like a couple stocks or a small percentage of your assets you want to play around with, but maybe not shifting in and out based on what's going on in the market. A great example is COVID. So, if you held broad market index in your retirement portfolio at this point in time and you sold it here, you would have lost quite a bit of money in the stock market. And we can kind of see that. Let's see if I can add... Okay, I can actually add the S&P 500. I don't know what this will look like, but no, it's not letting us really add it. But basically, it's just really not a good idea. You kind of just need to kind of hold on and just wait and see what happens. So this is GDP growth rates over time. We had a little bit of a decline in the growth rate here, but it looks like we're doing okay right now. So back to our slides and financial planning. So what determines your income, right? So there's all this stuff swirling around, and that also impacts your income. And, what sort of fields and majors are in demand? Obviously, your education level and where you live are going to impact your income and your spending. But your career is also going to be impacted by your education and where you live. Some average salaries could be like accounting, computer programming, lawyers, financial analysts, teachers. What do you sort of expect to have as an average salary? And those are things to think about when you're thinking about money and financial planning and your goals. Like, what kind of career is going to satisfy your spending needs now and later? Here's some median income numbers across the time horizon, and then also some median income numbers based on level of education. This data is sort of, it's really hard to argue against. Definitely, I think, and everyone who's listening to this, you're enrolled in school. But, I also think there is a great opportunity for those in skilled trades. people, we're kind of talking about two income households. People do not have time to do the things that they need to do to their cars or their homes. They're not going to, they don't have time or the skill to maintain these assets. So the skilled trades is also a really great way to earn a substantial income. And I wish, I actually should pull some information together on that. Just kind of looking at, what does like an electrician earn on an annual basis, or a plumber, or someone that doesn't have to go into technically like a 4-year university setting. That's not their that's not their interest. It's not where their skills are. So definitely a different way to go too. That's also very lucrative. And here's some other statistics. So here's the top, well, these aren't the top 5 actually. So these are different majors and mid-career and median career pay. So median mid-career and median early career. So everybody kind of starts out the same, and then people that tend to have degrees like in applied mathematics, business and economics, computer science, their median mid-career pay tends to outpace those with different degrees. Like a nursing degree, early career pay is quite high, but then it doesn't change very much, right? So whereas like someone who might have a business and economics degree, their early career pay is actually a little bit less than that of a nurse, but then they may expect to receive more income if they're able to wait. But that's why you often see people who have something like a nursing degree, like they might need income now, right? Like they might be supporting their family, and like that median mid-career pay increase, they don't necessarily need it or want it, or it's just not something that works for them. So nursing can be a really attractive field for that reason. And then which career will you choose? I think it's important to sort of identify what your interests are and your skills, needs, and values, right? So it's not just about your interests, and it's not just about your current skills, right? You can develop different skills, and you have certain values and needs financially to meet financial goals that I think are really important to take into consideration when choosing a career and thinking about all the different things that come with that career, what kind of education you need, how long it's going to take you to get where you're planning on getting. Set your long-term and short-term career goals, and think about what sort of action plan you need to achieve those goals. And then, like anyone, myself included, you often have to come back and review and revise your career plans as your situation changes. You may start a career and not really like it and have to change, or you may start a career and it doesn't work out and have to change. And so all of that is, there's a lengthy time horizon that we're most likely going to be working in now that we weren't 30 or 40 50 years ago. So you're probably going to change careers, and that's totally fine. And it's just good to kind of think about these steps and think about your interest and your skills and the skills you could develop and what you really need and value in the context of that career. So I hope you enjoyed this discussion, and I'll check in with you all in another edition.